Have you ever just looked at a huge pile of information? Could be, I don't know, financial reports, maybe customer surveys, or even just your own totally disorganized
Oh,
photos.
yeah.
And you think, how on earth do I figure out what's really important here without looking at every single thing?
It's like the classic modern problem, isn't it? We're swimming in data, but starved for real insight.
Absolutely. Well, welcome everyone to the deep dive. This is where we try to do exactly that. We take these complex sources, cut through all the noise, and pull out those really essential nuggets of knowledge for you.
That's the goal.
And our mission today is to take a topic that honestly sounds super technical, audit sampling, and make it really clear and actually useful. Because, at its core, it's all about making smart, informed decisions when you just can't check everything.
Yeah.
It's kind of a shortcut to being genuinely well-informed.
Exactly. And that's what we'll dig into. We'll look at the different, intelligent ways you can choose what to examine, the risks that are just inherent when you're making decisions based on, incomplete information, and the specific techniques that help make sure your conclusions are actually reliable, even if you only took a small peek into this huge universe of data. We're going to break every part down so it's easy to follow, really, no matter your background.
Okay, so let's unpack that core idea then. When you're testing things, could be financial records, product quality, maybe even figuring out if a new marketing campaign worked. There's
Yeah.
always that fundamental question, right?
Yeah.
How do you decide what specific things to actually review? You just can't look at everything all the time.
No, you definitely can't. And that really leads us to three main ways, three approaches for picking items when you're doing some kind of test or audit. The first one is pretty straightforward.
Yeah.
Just selecting all items.
Ah, the perfectionist's dream. When is that actually, feasible?
Well, it's practical in very specific spots. Like if you have a really small number of items, but they're incredibly high value, so every single one matters.
Yeah.
Or another case, if you're dealing with data where the whole audit procedure can be fully automated, that makes it super efficient to check everything.
Technology helps there.
Definitely. And of course, if the risk is just exceptionally high and anything less than 100% just isn't good enough. So yeah, if it's doable and absolutely necessary, you go all in.
Okay, so that's the ideal, maybe rare scenario. If you can't check everything, but you're not quite ready for full-blown sampling, what's the sort of middle ground?
That's where selecting specific items comes in. This is where you deliberately focus on certain things you identify as key items.
Yeah.
Maybe all the transactions over a certain dollar threshold or specific kinds of unusual transactions that catch your eye.
Right. So, if I'm looking at expenses, I might pull every single purchase over, I don't know, $10,000 because those are the big hitters financially. That seems logical.
Exactly. Makes perfect sense. And this is really crucial. There's a big limitation here. When you select specific items like that, your conclusions apply only to those specific items you looked at. You absolutely cannot project your findings onto the whole population. You can't say, well, all the big expenses looked okay, so the little ones must be fine too. It just doesn't work statistically.
Okay, that's a really important distinction. And that brings us then to the star of today's show, audit sampling. This is where you're applying some procedure to less than 100% of the items in a data set. Could be an account balance, a bunch of transactions,
Right.
with the goal of evaluating some characteristic for the entire group, the whole population.
And it's especially useful, particularly powerful, when you don't really have any specific hunches or, special knowledge about where problems or misstatements might be hiding in that big pile of data. You're trying to get an objective, sort of general feel for the whole picture.
So when you decide to sample, you're kind of making a big assumption, aren't you?
You are, yes. The fundamental assumption is that the sample you've picked is truly representative of the whole population, meaning whatever characteristics you see in your small sample, you're assuming those same characteristics hold true for the vast majority of the data you didn't look at.
And that leads us straight into the inherent risk, the gamble maybe in sampling, which is sampling risk. How would you explain that simply?
Sampling risk is absolutely critical to get your head around. It's the risk that the conclusion you draw just from looking at your sample would actually be different if you had somehow managed to look at 100% of the population.
Okay.
Think about like a political poll. If your survey accidentally interviews way too many people from one specific neighborhood,
Right.
your poll results might look one way, but the true overall opinion across the whole city could be quite different. That gap, that potential for a misleading conclusion based only on the sample, that's sampling risk.
That makes it really clear. Okay, so to give our samples the best possible chance of being reliable and, avoiding that risk as much as possible, there are some kind of golden rules for statistical validity, right?
Yes, there are some foundational principles. Rule number one is that for statistical methods to really work properly, you generally assume the population you're sampling from follows a normal distribution, that
Yeah.
classic bell-shaped curve.
Okay, the bell curve, got it.
And rule number two is all about the selection process itself. For those statistical estimates to hold up mathematically, your samples absolutely have to be unrestricted and randomly selected.
And what does that mean in practice?
It means every single item in the entire population has to have an absolutely equal chance of being picked for your sample, no bias whatsoever.
Right. No cherry picking the easy ones, no swapping out a selected item if it looks complicated. Pure, unadulterated chance. That sounds critical.
It is critical, which ties right into rule number three. If your sample is large enough and it's truly randomly selected, then it's highly probable, statistically speaking, that it will reflect the same characteristics,
Hmm.
things like the average value, the spread of values, as the entire population you drew it from. Essentially, it will be representative.
Okay. Large and random equals representative. Makes sense. And rule number 4 helps us measure that spread or variability within the population. That's the standard deviation, isn't it?
That's right. Standard deviation is basically just a statistical number that tells you how spread out the values in your population are from the average value. If everything's clustered really tightly around the average, your standard deviation is small. If the values are all over the map, it's large. It gives you a sense of the diversity or consistency within your data.
Okay, so with those basic rules down, let's explore the two big paths auditors take in sampling: statistical versus non-statistical sampling. You said they have the same goal, but get there differently.
That's a great way to look at it. Statistical sampling is, let's say, the more mathematically rigorous path. Auditors specifically state the level of sampling risk they're willing to live with, and then they actually calculate the precise sample size needed to achieve that level of confidence.
Ah,
And the results are evaluated objectively, quantitatively, using probability theory and formulas.
and the upsides there seem pretty clear. It helps you measure if you actually have enough evidence, right? Gives you an objective way to evaluate findings, helps you design an efficient sample.
And critically, yes, it lets
Yeah.
you quantify that sampling risk so you can actively manage it and limit it to an acceptable level.
And a key requirement for the statistical path is random selection.
Absolutely non-negotiable. You must use random sample selection methods for true statistical sampling. That's the only way to guarantee every item really did have an equal chance.
Okay, so if that's the rigorous mathematical route, what's non-statistical sampling?
With non-statistical sampling, the sample size isn't determined strictly by a formula. Instead, auditors rely much more heavily on their professional judgment and their experience to decide how many items to look at.
Hmm.
And they also use that same professional judgment to interpret the results they find. It's more subjective.
That brings up such a critical point. You mentioned judgment. Even with all the math and statistical sampling, professional judgment is always needed in both approaches, isn't it? The numbers don't just run themselves.
No, not at all. That's a common misconception, actually. Professional judgment is absolutely essential pretty much every step of the way.
Like where?
Well, identifying the right population to sample from in the first place, choosing the most appropriate sampling method for the situation, evaluating the actual evidence you collect, understanding why any errors or deviations you find occurred. Was it a one-off mistake or something systematic?
Right.
Carefully considering the sampling risk involved. And then finally, interpreting the sample results and making reasonable projections or conclusions about the entire population. It's the human auditor's brain that makes the analysis meaningful, not just the calculations.
Are there situations where these sampling ideas just generally don't apply? Where you wouldn't even bother with sampling?
Oh, yes, definitely. For instance, some procedures are just about understanding the system, like when you're doing your initial risk assessment walkthroughs. You're not really sampling then.
Okay.
Or think about highly automated IT controls. If you've already tested the general IT controls around the system and found them to be strong, you might only test that specific automated control once or maybe a few times. You wouldn't necessarily sample thousands of automated transactions if the underlying system is proven reliable.
Right. Testing the system versus testing every output.
Exactly. And also, controls that don't leave a clear audit trail, like observing if people are properly segregating duties or assessing the company's overall ethical tone.
The tone at the top.
Yeah, those aren't typically subject to sampling in the same way. You're observing or inquiring, not picking items from a list to verify.
This is a good point to zoom out a bit and talk about the big picture of audit risk. We've hit sampling risk hard, but that's just one piece of the uncertainty puzzle, right?
That's absolutely right. Audit risk is the sort of overall inherent uncertainty that comes with applying any audit procedure. It's made up of two main components: uncertainties that come from sampling, which we've been discussing, and uncertainties that come from factors other than sampling.
Okay, let's dive back into sampling risk for just a second, but maybe explore the specific types. We know it's about the sample maybe not matching the whole population. How does this actually show up in different kinds of tests?
Good idea. Let's first look at the risks when you're doing substantive testing. Remember, this is focused on dollar values, like testing an accounts receivable balance. Here, you face two key risks.
Okay, what's the first one?
The first, and arguably the more serious one, is the risk of incorrect acceptance.
That sounds bad. What is it?
It's the risk that your sample leads you to conclude that a financial balance is actually okay, that it's not materially misstated, when in reality it is materially misstated.
Whoa! So your sample basically gives you a false sense of security. It misses a real significant problem.
Exactly. You failed to flag something important. Imagine auditing accounts receivable again. You send confirmations to your sample, they come back looking good, you conclude the balance is fine.
Okay.
But if you had tested every single account, you would found a huge chunk of bad debt that actually made the balance materially overstated. Your sample led you to incorrectly accept a bad number.
Ouch.
This relates directly to the effectiveness of the audit. Did you actually detect the problem that was there? This is the one auditors worry about most.
I can see why. What's the flip side risk in substantive testing?
That's the risk of incorrect rejection. This is when your sample suggests that a balance is materially misstated, but in reality it's actually okay.
So your sample flags a problem that isn't really there.
Right. It leads you down a rabbit hole. This type of error mainly impacts the efficiency of the audit. It causes you to do a lot more work, chasing down what turns out to be a non-issue, trying to figure out a material misstatement that doesn't actually exist.
Okay, so incorrect acceptance hits effectiveness, missing a real problem. Incorrect rejection hits efficiency, causing extra work.
Got it. Now, how do these risks translate when we're doing tests of controls, looking at whether procedures are being followed correctly?
Very similar concepts apply, just framed differently. Here, we talk about the risk of assessing control risk too low. This is also a critical one, directly impacting audit effectiveness.
What does that mean?
It's the risk that your sample suggests that the internal controls are working effectively, meaning the rate of deviations or errors is acceptably low, when in reality they aren't working well at all, and the actual deviation rate in the population is much higher than your sample indicated.
Can you give an example of where that would really hurt?
Sure. Let's say you're testing a control that requires 2 signatures on all checks over $10,000. You pull a sample of, say, 10 checks over that amount, and every single one has 2 signatures.
Looks good so far. Right, so you think, great, this control's reliable. You assess the control risk as low. But what if, unknown to you, out of the 100 total checks issued over $10,000 that year, 89 of them actually only had 1 signature?
Wow, so your perfect-looking sample of 10 was completely misleading compared to the whole population.
Totally misleading. Your sample showed a 0% deviation rate, but the true population rate was 89%. That's the danger of assessing control risk too low. You end up placing reliance on a control that's actually failing miserably. It undermines the effectiveness of your entire audit strategy.
Okay, that's serious. What's the counterpart to that?
That's the risk of assessing control risk too high. This is when your sample suggests that controls aren't working effectively. Maybe you find a couple of deviations in your small sample, but in reality the controls are generally working just fine across the whole population.
So, similar to incorrect rejection, this one hits efficiency.
Exactly. Your sample indicates a higher problem rate than truly exists. This usually leads you to do more substantive testing than might have been necessary because you incorrectly concluded you couldn't rely on the controls. It makes the audit less efficient.
Okay, let me see if I've got this. The risk of incorrect rejection and the risk of assessing control risk too high both lead to wasted effort, inefficient audits. But the really dangerous ones are the risk of incorrect acceptance and the risk of assessing control risk too low, because that's where you might actually miss a significant problem or rely on a broken control.
You've nailed it. That's precisely why auditors set the acceptable risk levels for those effectiveness-related risks. Incorrect acceptance and assessing control risk, too low, quite low, often around 5% or maybe 10%. They want to be 90% or 95% confident that their sample isn't misleading them in those critical ways.
Okay, so that covers sampling risk pretty thoroughly, but you also mentioned non-sampling risk. What falls into that bucket?
Non-sampling risk is basically everything else that can go wrong in an audit that has nothing to do with the fact that you only looked at a sample.
Like what?
It could be things like um, choosing an audit procedure that's just not the right one for the job, or maybe even using the right procedure but failing to spot a misstatement that's right there in the document you're looking at. Simple human error.
Ah, so it's more about mistakes in judgment, planning, or execution rather than the statistics of the sample itself.
Exactly. Non-sampling risk is always there, lurking in the background. And unlike sampling risk, you can't really put a number on it. You can't measure it quantitatively. The main ways to combat it are through really good planning, proper supervision of the audit team, and having strong quality control processes within the audit practice itself.
Okay, that makes sense. Let's transition now into the specific sampling methods. Let's start with attribute sampling. You mentioned this is mainly for tests of controls, and it's about those yes-no questions.
That's a perfect summary. The whole point of attribute sampling is to estimate the rate of occurrence, or you might call it the exception rate or deviation rate of a specific characteristic in a population. You're essentially asking binary yes or no questions. Was this invoice properly approved? Yes or no. Was this time card authorized? Yes or no. We're trying to figure out how often a specific control didn't work as intended.
So when you're planning to do attribute sampling, what are the key things you need to think about before you even start picking items?
Okay, first you need to be absolutely clear on how the sample you're about to take directly relates to the objective of the specific control you're testing. What question are you actually trying to answer?
Right.
Then, a really important concept, the tolerable deviation rate. This is the maximum rate of errors or deviations in a control procedure that you're willing to accept or tolerate without having to change your planned reliance on that control.
So if a control is supposed to catch duplicate payments, maybe I can tolerate it missing, say, 1% of the time before I get really worried. That 1% would be my tolerable deviation rate.
Exactly. You also need to define your allowable risk of assessing control risk too low. Remember that effectiveness risk. How confident do you need to be? Usual 90% or 95% confidence, meaning 10% or 5% risk.
Okay.
And finally, you consider the expected deviation rate. This is simply your best guess, maybe based on last year's audit or your initial understanding of what rate of errors you actually expect to find in the population this year.
This whole idea of deviation rates can get a bit tricky, right? Like what you find in your small sample isn't necessarily the exact rate for the whole population.
No, absolutely not. Your sample deviation rate, the number of errors you find divided by your sample size, is just your point estimate based on the limited data you saw.
Right.
But as auditors, we tend to be conservative. We worry about the worst-case scenario, so we calculate something called the upper deviation rate. This is a statistically calculated estimate of the highest likely deviation rate in the entire population, given what we found in our sample and the level of risk we're willing to take.
How do you get that?
You essentially add an allowance for sampling risk. Think of it as a statistical cushion or buffer to your observed sample deviation rate. This allowance accounts for the uncertainty that comes from only looking at a sample.
So if my sample of 100 items had 4 errors, my sample deviation rate is 4%. But maybe after adding the allowance for sampling risk, my upper deviation rate comes out to, say, 8.5%.
Exactly. In that case, the allowance for sampling risk would be 4.5%. The 8.5% upper rate minus the 4% sample rate. That 4.5% is your statistical safety margin.
Got it. That makes sense. Okay, let's try to walk through a step-by-step example. Let's say we're testing for missing credit approvals on sales orders using attribute sampling. Where do we start?
Okay, step 1, define the objective. Be really precise. Here, it's determine the percentage of sales orders processed during the year that are missing the required credit approval. Clear, measurable goal.
Okay, objective set. What's next?
Step 2, identify the population. In this case, it would logically be all sales orders that were used during the period you're auditing, say, the entire year. You also need to think about making sure your population listing is complete. Using a pre-numbered sales order register is often better than just sampling from physical files, for instance, to make sure none are missing from your list.
Right, completeness is key. Then step 3, define the sampling unit.
Correct. The sampling unit is the individual item you're going to select and examine. Here, it's each individual sales order.
Straightforward enough. Step 4, Define the attributes of interest, or what counts as a deviation.
Yes. What exactly constitutes an error or deviation in this test? Obviously, a sales order that's missing the required credit approval signature is a deviation. But sometimes you might also define other things as deviations. For example, if you select a sales order number from the register, but you can't even locate the physical document, that's often treated as a deviation too, because it indicates a potential breakdown in controls over documentation.
Okay, so we know what we're looking for and what counts as a miss. Step 5. Determine the sample size. How many orders do we actually need to look at? This sounds like where those factors we discussed come in.
Exactly. Several factors influence this, and they work in different directions.
Yeah.
There's an inverse relationship between sample size and both your acceptable risk of assessing control risk too low and your tolerable deviation rate.
Inverse meaning.
Meaning, the higher the risk you're willing to accept, or the higher the error rate you can tolerate, the smaller your sample size needs to be. You need less evidence if you're willing to accept more uncertainty or more errors.
Okay, that makes intuitive sense. And the other direction.
There's a direct relationship with the expected deviation rate.
Mm.
The higher the rate of errors you expect to find based on past experience, the larger your sample size needs to be to get a reliable estimate of that rate.
More expected errors means you need to look at more items to confirm it. Makes sense. What about the total number of sales orders? Does population size matter much?
Interestingly, once the population gets reasonably large, usually considered over about 5,000 items, the actual size has very little effect on the sample size needed for attribute sampling. It's kind of counterintuitive, but the math works out that way.
Huh. Okay. So let's put some numbers on this. Say we decide we can accept a 5% risk of assessing control risk too low. We expect maybe a 1% deviation rate based on last year, and we can tolerate up to a 6% deviation rate before we change our audit plan. How big a sample would that lead to?
Okay, using standard attribute sampling tables, with those inputs 5% risk, 1% expected, 6% tolerable, you'd likely land on a sample size of around 78 sales orders.
Okay, 78. And how would that change if, say, we expected fewer errors, maybe only 0.5%?
If your expected deviation rate went down, your required sample size would also decrease. You'd need less evidence.
What if we could tolerate more errors, say up to 8%?
If your tolerable deviation rate increased, your sample size would decrease again. More tolerance means less testing needed.
And if we were willing to take more risk, say a 10% risk instead of 5%, same effect. Higher acceptable risk means a smaller sample size. It all comes back to how much assurance you need.
That principle is really clear now. Less certainty needed or more tolerance for error equals a smaller sample. Okay, so we've got our sample size, say 78. Step 6, select the actual sample. How do we pick those 78 sales orders?
The gold standard is random selection, using something like a random number generator or specialized software to ensure every single sales order in that population has an exactly equal chance of being picked.
Okay.
You could also use systematic selection, for example, picking every 50th sales order after a random start. But you have to be careful with systematic selection. If there's some kind of pattern in how errors occur in the population that happens to align with your selection interval, like every 50th item always being processed by the new guy, it could bias your sample.
Good point. What about just grabbing a stack from 1 month, like block sampling? No, block sampling, where you just take a chunk of consecutive items like all sales orders from March, is generally not considered acceptable for projecting results because it's highly unlikely to be representative of the entire year.
Okay, avoid block sampling. Got it. So we've selected our 78 items randomly. We've examined them for missing credit approvals. Step 7, evaluate the sample results. What do we do with what we found?
First, you calculate your raw sample deviation rate. Just divide the number of deviations you found by your sample size. Let's say, just to make the math easy for a moment, we tested 100 sales orders instead of 78 and found exactly 1 order missing credit approval.
Okay, 1 error in 100. That's a 1% sample deviation rate.
Correct. But remember, that's just the sample rate. We need the upper deviation rate. So you go back to your statistical tables, using your actual sample size, 100 in this case, the number of deviations found 1, and your acceptable risk level, say 5%. The table would give you the corresponding upper deviation rate. For 1 deviation in 100 at 5% risk, that upper rate might be, for example, 4.7%.
So even though we only saw 1%, we have to conclude we're 95% confident the true error rate in the whole population doesn't exceed 4.7%.
Exactly. And that difference between the upper rate, 4.7%, and the sample rate, 1%, which is 3.7%. In this case, that's your calculated allowance for sampling risk. It's the buffer the statistics add for the uncertainty.
Okay, this is leading to the final step, right? Step 8. Form conclusions about the internal control based on these results.
Yes, this is the moment of truth. You make the critical comparison. Is your calculated upper deviation rate less than or equal to your predetermined tolerable deviation rate?
So in our example, our upper deviation rate was 4.7%. Let's say our tolerable rate was 6% from step 5. How does that compare?
Since 4.7% is less than or equal to 6%, your conclusion would be, yes, based on the sample results, you can rely on the control as planned. The potential deviation rate is within acceptable limits.
Okay. But what if our tolerable deviation rate had been lower? Say, we decided we could only tolerate 3% deviation.
Well, in that case, your calculated upper deviation rate of 4.7% exceeds your tolerable rate of 3%.
Hmm.
So your conclusion would be the opposite. No, you cannot rely on this control to the extent you originally planned.
And what happens then?
You'd have to modify your audit strategy. Maybe you'd test some other compensating controls more thoroughly. Or, more likely, you'd have to significantly increase the amount of substantive testing you do on the related financial statement balances, like sales and accounts receivable, to make up for the fact that this control isn't reliable.
And the key takeaway here, the big warning, is always use the upper deviation rate for this conclusion, not just the raw sample rate.
Absolutely critical. Never base your conclusions solely on the sample deviation rate. Always use the statistically calculated upper deviation rate that incorporates the allowance for sampling risk. That's the conservative, appropriate approach.
And of course, the final step, document everything, every decision, every calculation, every conclusion.
Every single step needs to be clearly documented in the audit work papers. Yes.
Now, are there other types of attribute sampling besides this main approach? You mentioned a couple earlier.
Yes, there are a few specialized models. One is called discovery sampling.
Right, the detective one.
Yeah, it's used in specific situations where you expect literally zero deviations or maybe just one or two, and you're specifically looking for something really critical, maybe an indicator of fraud. You calculate a sample size designed to give you a very high probability, say 95% or 99%, of finding at least one instance of the critical deviation if it exists in the population at a certain very low rate.
So if you find one, it's a huge red flag.
Exactly. If you find nothing, you gain confidence. It's extremely rare. If you find even one, it usually triggers a much deeper, often forensic investigation.
Okay. And the other one was stop-or-go sampling, also called sequential sampling.
Right. This one's all about audit efficiency. It's designed particularly for situations where you expect a very low error rate. It allows you to test the sample in stages. If after the first small stage you find zero or very few errors, you might have enough evidence to stop testing right there and conclude the control is effective, saving you from having to complete the full, larger sample size you might have initially planned.
Sort of like, looks good so far, no need to keep going unnecessarily.
Precisely. It avoids over-auditing when the initial results are very positive.
Okay, so that covers attribute sampling, which is all about those yes-no questions, deviation rates, testing controls. But what about when we need to estimate actual dollar amounts? That's where variable sampling comes in, right? Mostly for substantive testing.
Exactly. With variable sampling, we shift focus. The purpose isn't to estimate a rate of occurrence, but to estimate a numerical measurement of a population most commonly, an account balance like accounts receivable or inventory value. It's used primarily in substantive testing to gather evidence about the reasonableness of monetary amounts recorded in the financial statements.
So when you're planning for variable sampling, what are the key things to consider upfront? Still similar to attribute sampling.
Some similarities, yes. You always start by relating the sample to your specific audit objective. What balance are you trying to verify? But a really key concept here is tolerable misstatement.
Tolerable misstatement. How is that different from tolerable deviation rate?
Tolerable misstatement is the maximum dollar amount of error you're willing to accept in a specific account balance or class of transactions without considering it to be materially misstated. Think of it as applying your overall planning materiality, or more specifically, your performance materiality, down to this particular sampling procedure. It's your threshold for pain in dollars.
So if overall materiality for the company is $1 million, maybe tolerable misstatement for the accounts receivable balance might be set at $200,000, something like that.
Exactly. You also, similar to attribute sampling, consider your allowable risk of incorrect acceptance. That effectiveness risk, again, how much chance are you willing to take that you'll accept a balance that's actually materially misstated? And you also consider the characteristics of the population itself, especially its variability. How spread out are the dollar values?
And what about selecting the sample In variable sampling, are there special considerations?
Yes, a really important one.
Hmm.
Any individual items in the population where a potential misstatement just in that single item could by itself exceed your tolerable misstatement, think very large dollar value accounts, or highly unusual
The
transactions.
really big fish.
Exactly. Those items should generally be pulled out and examined 100%. They are not part of the population you sample from. You test them separately because they're individually significant.
That makes total sense. Why risk missing a huge error in one item by just sampling it?
Precisely. Another vital technique, especially in variable sampling, is stratification.
Stratification, what's that?
It means dividing the entire population into subgroups, or strata, where the items within each subgroup are more similar to each other, usually based on dollar value. For instance, you might group all accounts receivable balances over $50,000 into one stratum, balances between $10,000 or $50,000 into another, and all balances under $10,000 into a third stratum.
Okay, so you create layers based on size. Why do that?
You then treat each stratum as a separate population for sampling purposes.
Mm.
The huge benefit is that it usually dramatically reduces the total sample size needed. Why? Because items within each stratum are more homogeneous, more alike, so their values are less variable. Less variability means you need a smaller sample from that stratum to get a reliable estimate. It makes the whole process much more efficient.
Ah, so instead of randomly picking from a huge range of values, you sample more intensely from the high-value stratum and maybe less intensely from the low-value stratum.
That's often how it works out, yes. It focuses your effort where the dollar risk is highest.
Okay, so once you've done your stratified sampling and tested the items, you get a projected misstatement, right? Which you compare to your tolerable misstatement.
Exactly. You calculate the misstatement found in your sample for each stratum, then you project that misstatement out to the entire stratum's population value. Summing up the projected misstatements from all strata gives you your total projected misstatement for the entire account balance.
And then you compare that total projection to your tolerable misstatement threshold.
Right. If the projected misstatement is, say, well below your tolerable misstatement, you likely have sufficient evidence the account isn't materially misstated.
But what if it's close? Like my projected misstatement is $180,000 and my tolerable was $200,000.
Now that's where judgment comes in again. If your projected misstatement is getting uncomfortably close to your tolerable misstatement, there's a higher risk that the actual misstatement in the population, which your sample only estimates, might actually exceed that tolerable amount, even if your projection is slightly below it. You might need to do more work or investigate further. You can't just automatically accept it if it's too close for comfort.
Okay. Now, there are different ways to actually calculate that projection, right? You mentioned three classical variables sampling plans.
Yes, three main approaches to estimate the population value or misstatement. The first is mean per unit estimation, or MPU.
Mean per unit, average per item.
Pretty much, it's quite intuitive. You calculate the average audited value of the items in your sample. Then you simply multiply that average value by the total number of items in the population to get your estimate of the total population value. It's useful, especially if you don't even have a reliable recorded book value for the population to begin with. However, MPU can be very sensitive to high variability in the population values. If you happen to pick a few extreme highs or lows in your sample, it can really skew the average. That's why stratification is almost always used with MPU, to reduce that variability within each stratum you're averaging.
Okay, so MPU uses the average value. What's the second method?
Ratio estimation. This method uses the ratio of the total audited value, the correct value of your sample items, to the total book value, the client's recorded value, of those same sample items.
So like audited value is 95% of book value in the sample.
Exactly. You calculate that ratio from your sample, and then you multiply the total book value of the entire population by that ratio to project the estimated true population value. It's very efficient statistically, but it works best when the amount of misstatement in an item tends to be proportional to the item's book value.
Okay. And the third one?
Difference estimation. This one focuses on the difference between the audited value and the book value for each item in your sample. You calculate the average difference per item in your sample.
So on average, items were overstated by $5 in the sample.
Right. Then you multiply that average difference by the total number of items in the population to get the total projected dollar difference or misstatement for the whole population. You typically use difference estimation when the differences you find are relatively constant dollar amounts, not necessarily proportional to the book values of the items.
So MPU ratio difference, is one generally better than the others?
Well, ratio and difference estimation usually requires smaller sample sizes than MPU, especially if you expect to find a fair number of both overstatements and understatements. They tend to be more efficient in those common scenarios. The choice between ratio and difference depends on whether the errors are proportional to book values or not. But MPU is always an option, particularly if you lack reliable book values, or if stratification really minimizes variability.
Okay, let's try a quick conceptual walkthrough. Estimating an accounts receivable balance using variable sampling.
Okay, step one, define the objective. Estimate the true audited value of the total accounts receivable balance.
Step 2, identify the population. Let's say it's 5,000 customer accounts with a total recorded book value of $4.5 million. And remember, we'd have already pulled out any individually massive accounts for 100% testing.
Good point. Step three, define the sampling unit. Here, it's each individual customer account balance.
Step 4, determine the sample size. This depends on factors like
Factors that increase sample size would be higher expected misstatement, if you think there are lots of errors, higher variability in the account values, standard deviation, or a higher assessed level of inherent or control risk.
and factors that decrease sample size.
Higher tolerable misstatement, more error you can live with, or a higher acceptable risk of incorrect acceptance, more risk you're willing to take.
Okay. Step 5, select the sample. Needs to be representative, so maybe stratified random sampling. Then we'd send out confirmations to those selected customers to get the audited values.
Correct. Confirmations are a very common way to get that evidence for receivables. Step 6, evaluate the sample results and project the misstatement. Let's say we sampled 200 accounts out of the 5,000. Their total book value was $184,200, but after confirming them, we found their true audited value was only $175,000.
So there's a $90 to $200 difference, an overstatement, in our sample of 200 accounts.
Right, now we project this using, say, MPU. The average audited value per sampled account is $175,000, 200 value $875. Multiply that by the total population size. $875,000 accounts, $4,375,000 projected population value.
Okay, so MPU projects $4,375,000. How about ratio?
Ratio, audited value of sample book value, sample total population book value. So $175,000, $184,200. $4.5 million, approximately $4,275,244 projected value.
Slightly different.
And difference. First, find the average difference per item in the sample. $184,200 book, $175,000 audited. 200 accounts, 86 average overstatement per account. Project that. 46 $5,000 accounts equals $230,000 total projected overstatement. Subtract that from the total book value. $4.5 million. $230,000 equals $4,270,000 projected value.
Wow. Okay, so the different methods can give slightly different point estimates. That's interesting. And to each of these point estimates, $4.37 MPS, $4.28 CEMPIS, $4.27 MPS, you'd add that allowance for sampling risk, that precision interval, to get a final acceptable range.
Precisely. You calculate that allowance based on your sample variability and risk levels. Let's say your chosen method, maybe difference, give a point estimate of $4.27 million, and your calculated allowance for sampling risk was plus or minus $150,000. Your acceptable range would be $4.12 million to $4.42 million.
Okay, step 7, form conclusions. You compare the client's recorded book value, $4.5 million in our example, to that acceptable range, $4.12 messes, $4.42 cents.
Right. In this case, the recorded book value of $4.5 million falls outside our calculated acceptable range. It's too high. So we'd conclude the accounts receivable balance appears to be materially overstated.
And then you'd propose an adjustment to the client. What happens if some items you selected just couldn't be audited? Like a customer didn't return a confirmation and you couldn't verify it another way.
Yes, the scope limitation issue.
Yeah.
You have to consider their potential effect. If treating all those unexamined items as 100% misstated still wouldn't push your total projected misstatement over the tolerable limit, you might be okay. But if treating them as misstated would result in a potentially material misstatement, then you absolutely must perform alternative procedures to get evidence about those items. You can't just ignore them if they could be material.
Makes sense. And again, document, document, document every step.
Always. And it's worth mentioning audit data analytics, ADAs, again here briefly. Auditors are increasingly using tools to analyze 100% of transactions in certain areas, group them, identify outliers or potential misstatements automatically. It doesn't eliminate sampling entirely, but for tests of details, ADAs can help auditors focus their attention much more effectively, essentially doing a very sophisticated form of specific item selection or risk analysis on the whole dataset.
Okay, one more major sampling technique to cover. Probability proportional to size, or PPS sampling. That sounds kind of different, like a hybrid.
It really is quite unique. PPS is interesting because it defines the sampling unit not as a transaction or an account, but as an individual dollar within the population's book value.
An individual dollar, how does that work?
You essentially assign all the dollars in the population consecutive numbers. Then you randomly select specific dollar numbers. Whichever dollar number you select, you then audit the entire account balance or transaction that contains that specific dollar.
Huh. That's clever. So it uses dollars as hooks to pull entire accounts.
Exactly. And it uses the underlying math and theory of attribute sampling. Yes, no decisions on the dollars, but manages to express its final conclusions in dollar amounts, making it suitable for substantive testing.
What are the big advantages of doing it this way?
A major advantage is that it automatically emphasizes larger items. An account with a $10,000 balance has 10,000 chances, dollars to be selected, while an account with a $100 balance only has 100 chances. So larger balances are naturally much more likely to be picked. It acts like automatic stratification based on size.
Ah, very efficient.
Yes. And another advantage is that if you expect very few or no errors in the population, PPS sampling often results in a smaller sample size compared to classical variable sampling methods.
Okay, sounds good. Any downsides or situations where it's not ideal?
Yes, it does have some quirks. It requires some special handling if you have accounts with zero balances or negative credit balances in your population. And it's generally not the most efficient method if you expect to find a lot of understatements, because it's primarily geared towards finding overstatements based on the recorded book values.
Okay. How do you figure out the sample size for PPS? Is it complex?
It's actually quite straightforward. You first calculate something called the sampling interval. You get this by dividing your tolerable misstatement in dollars by a reliability factor.
Reliability factor, where does that come from?
It comes from a standard statistical table based purely on the risk of incorrect acceptance you're willing to take. For example, for a 5% risk, the reliability factor is typically 3.0.
Okay, so tolerable misstatement divided by reliability factor gives the sampling interval. Then how do you get sample size?
The sample size is simply the total recorded population amount in dollars divided by the sampling interval you just calculated.
Let's try an example. Say tolerable misstatement is $15,000, risk of incorrect acceptance is 5%, so reliability factor is 3.0, and the total recorded accounts receivable is $500,000.
Okay, sampling interval $15,000, 3.0 equals $5,000.
Got it. Interval is $5,000.
Sample size, $500,000 population, $5,000. Interval, U100 items. So you need to select 100 logical units.
Okay, sample size is 100. How do you actually select those 100 accounts using this dollar unit approach?
You use the sampling interval, $5,000 in our example. First, you pick a random starting dollar number somewhere between $1,000 and $5,000. Let's say your random start is $12,024.
Okay.
Then you systematically select every $5,000 after that. So you'd select the account containing the $1,234, then the account containing the $6,234, $1,234 plus $5,000, then the $11,234, and so on until you've gone through the entire $500,000 population. This process will select exactly 100 accounts.
And how do you know which account contains, say, the $6,234?
You typically have a list of the accounts with their balances and a cumulative running total. You just find where the $6,234 falls within that cumulative total. Also, importantly, any single account balance that is larger than the sampling interval, larger than $5,000 in this case, gets selected automatically, possibly multiple times depending on its size, ensuring those huge items are always tested.
That really is a clever way to automatically focus on the big items. Okay, so you've selected your 100 accounts using this PPS method, you've audited them. How do you evaluate the results? What if you find errors?
If you find zero errors in your PPS sample, then your projected misstatement for the entire population is zero. Assuming your sample size was appropriate, you'd conclude the recorded balance is likely not materially misstated.
But what if you do find errors?
If you find misstatements, you have to project them. For items with book values less than the sampling interval, you calculate a tainting percentage.
Tainting percentage, explain that.
It's simply the amount of the misstatement divided by the recorded book value of the item. So if you selected an $800 account receivable using your $5,000 interval and you found it was overstated by $200.
Okay.
The misstatement is $200, the book value is $800. The tainting is $200. $800 is 25%.
Okay, 25% tainting. What do you do with that?
You multiply the sampling interval by the tainting percentage. So $5,000 interval, 25% tainting equals $1,250 projected misstatement for that specific error finding. You do this for every error found in items smaller than the interval, For items larger than the interval that were automatically included, you just use the actual dollar amount of the error found. No tainting needed.
Okay, so you sum up all those projected errors, tainted ones plus actual dollar errors from large items, and then
Then you still need to add an allowance for sampling risk, similar to other methods, often calculated using factors from PPF tables based on the number of errors found. The final result is your upper limit on misstatement, which you compare to your tolerable misstatement.
so it really does manage to use that attribute theory foundation to arrive at a dollar value conclusion. That's quite elegant.
It's a very powerful technique in the right circumstances. But remember, with all these sampling methods, whether attribute, variables, or PPS, the numbers are only part of the story. We always have to consider the qualitative aspects of any deviations or misstatements we find.
You mean digging into the nature and the cause of the problems? Was it just a simple mistake, unintentional human error? Or was it something deliberate, something indicating potential fraud?
Exactly. An intentional misstatement, fraud, obviously carries far broader implications than an honest mistake. Finding potential fraud usually requires a much wider investigation and a completely different response than just correcting an error.
Right.
You also need to think about how findings in one area, say weak controls over cash disbursements found through attribute sampling, might relate to or impact other parts of your audit, like your risk assessment for potential cash misappropriation. Everything's interconnected.
That makes sense. And one last quick topic, dual-purpose samples. What are those about?
Dual-purpose samples are pretty efficient when used correctly. It's when you design a single sample of items that you use to perform both a test of control and the associative test of detail simultaneously on that same set of items.
So using the same sample for two different jobs, when would you do that?
You typically only consider it when you have an acceptably low risk that the actual rate of deviation from the control you're testing is going to exceed your tolerable rate. In other words, you have a pretty good expectation that the control is working reasonably well.
So if you're pretty confident in the control, you can use the same sample to check both if the control worked, like was the invoice approved, and if the dollar amount on the invoice was correct. Seems very efficient.
It can be. But there's a critical rule.
Yeah.
The sample size for a dual-purpose test must be the larger of the sample sizes that would have been required for the two tests performed separately. You can't just use the smaller size.
Ah, okay. You have to satisfy the needs of both tests.
Right. And when you evaluate the results, you have to evaluate the control deviations and the monetary misstatements separately, using their respective risk levels and objectives. Finding no monetary errors doesn't automatically mean the control was effective, and finding control deviations doesn't automatically mean there are dollar errors. You assess each aspect independently based on that single sample.
Got it. So efficiency, but you still need to be careful in the evaluation.
Precisely.
Wow, what an incredible journey through the world of audit sampling. We went from just understanding why we sample in the first place, through all these different techniques, attribute for yes, no, variables for dollars, the unique PPS approach, plus managing all those risks, and remembering that judgment is key throughout.
It really boils down to that core idea, doesn't it? That sampling, when you do it correctly and thoughtfully, can give you amazing insight and clarity. It helps you understand the big picture without getting totally bogged down in every single tiny detail.
It really does feel like a smart shortcut to becoming genuinely well-informed about complex systems, and it helps you make better, faster decisions, even when looking at everything just isn't an option.
Absolutely. These principles apply far beyond just auditing.
So, as you all go about your week, maybe think about this. We want to leave you with a final thought. In this world we live in, just drowning in data, what's one area, maybe in your work, maybe in your personal life, where applying a kind of sampling mindset, deliberately choosing what to focus on to get representative insights, could lead you to a surprisingly effective conclusion or decision?
Yeah, just think about it. Could be reviewing a massive project plan, maybe sifting through customer feedback, even just trying to get a handle on your overflowing email inbox. How can you strategically sample to get the knowledge you need efficiently?
It's a powerful way to think. Thanks so much for deep diving with us today.